Good afternoon, everyone. This is Brad Matheny. Today is the 19th of May. We are going to be doing the webinar related to the clockwork group strategies. Go ahead and hide this little thing. And what an incredible day. Let's start off by going over here. Jamie's going to be a little late, so I'm going to wait for him to join. Want everyone to be aware that Jamie, when he joins, will be showing us live strategies running on his systems related to the clockwork group. We're going to go through some of these as we get started. He should be about 10, maybe 12 minutes late to get in here. He ran into a little traffic problem trying to get back from taking his family somewhere. But anyway, let's go take a look at the chart. So here we have the SPX weekly chart. I had a member ask me a question today asking if we thought this 3,500 level down here would be a really reasonable target for later this year. And you need to understand, as I've explained to you before, the way Fibonacci price theory works. I'm going to draw a couple of lines. So this is a weekly chart. We have a lot of data going in here. Let me try to crunch this down a bit. And be aware, ladies and gentlemen, that we have an ultimate high back over here. The zigzag indicator being drawn on here. And that gives us a fairly clear picture of price rotation. Then we have the ultimate low back down here, which acts as a critical support level. So we'll try to make that green. Now, once we have these ultimate high and low patterns here, folks, this sets up a range where we can now attempt to identify other unique and or critical highs and lows. And if you followed my Fibonacci price theory videos, you'll understand that a unique high or low is a low or high that has not been touched in the last 10, 15, maybe 20 bars. And it all depends on the interval. So we're on a weekly chart right now. So I'm basically going to operate on the 10 to 15 bar range. So this becomes a unique high because the high has not been touched in the last 10 or 15 bars. So I'm going to draw a line across here. Obviously, we just got above it. Make it kind of a purple color. And this we need to count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Yes, this did meet the 10 to 15 bar criteria. So this then becomes a unique high. Obviously, we got above it right over here. And I want you to be aware that this could be a rejection setting up right here. We need to see. So this is this a unique high? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Technically, it is a double top unique high coming from this area right here, which we technically breached here. So I will draw that here. Where are we seeing unique lows? Does this qualify as unique low? Probably not, because we got below it here. Does this qualify as unique low? Probably not. These become what are called critical lows. Critical lows are reasonable points for rotation in the market, which act as a modicum or a moderate level of support. So understand that we are seeing critical lows here. And of course, we have another one. Don't want to forget about this little guy right over here. So at this point, we have seen on a weekly basis measured moves through this rotation up into this rotation here. Now there are moderate, let's call them critical highs in this area. Do this as a light pinkish color. We have another right here. And again, this is weekly data, so this is very long term. What I'm trying to do is show you how We are having these setups. We see these setups occur in longer term price action. So here we have a, let me see if I can find the, not there anymore. Do you have any arrows, stickers, icons? Maybe it's icon. Okay, so here we have a rally above this bar right here, generates the icon. We will copy and clone. We will try to get this one. And as we move higher, we set up these levels. We set up these intermediate levels. We get above this intermediate level. This creates another bullish trigger. And clone again. And now we get above this purple line right here, sets up another bullish trigger. So we have a series, oh, somehow I rolled this one around. We have a series of bullish triggers taking place in these areas right here. Okay. Bullish, bullish, bullish. Do we have any real bearish triggers? Do we have any breakdown lows? Not really. We don't see any real breakdown lows yet. So now that we've gotten above this level, we've established our extreme ultimate highs and lows. We are now looking at this level, this rejection. We got above it, we got rejected, back below it. This would indicate that we're setting up for potential consolidation into this area, potentially maybe moving up to this area into mid-June, July, and then moving down into August, September, somewhere down into this area. We also have price channels setting up that need to be very clear in how we understand price trending. So from these lows, we have price channels coming across here. We could go to these body areas here. And again, a body area means we're coming to this close and this open, using this as a support channel. I'll make this a blue color. And I would bet that if we move all the way out, and try to take a look at trending, we don't have any other real trending base except for this area. We have this expanding wedge, which I think is very important to follow. So understand that we have this kind of an expanding wedge formation. We also have this kind of an expanding wedge. Let's see if it lines here. Not really. So I will go off of this channel. Try to carry it out over here. Very interesting how that channel, which if you do understand anything about Gann analysis, you will realize that this channel, a little too high, I'll leave it right down in this area, sets up a very important wedge. Now we could also have this type of a channel across here. And we could also potentially have this type of a channel across here, across these levels, that could play secondary roles in where this trend is actually moving. So Gann's theory was that every price peak, every price trough correlates into infinity out around critical price structure. So essentially what I'm trying to tell you is that the lines that you can draw off of price peaks essentially correlate into infinity, which could be why we saw this consolidation over here. So this expanding price wedge, when we get down to the midpoint of this expanding price wedge, you're roughly in this area. Okay, I'm going to draw this as a rough number. And this gives us the ability to then determine from this midpoint level to this critical level, we could hypothetically come in and say, okay, Fibonacci, tell us where price levels would be. And now I'm looking to do this to try to confirm this 3,500 level. And in reality, this 618 level right here is 3,537. So from the midpoint, which is considered the belt line of the expanding wedge formation from 2018, 19, and 20 up to this expansion, we could have a pullback like we saw earlier down into this 35, 37, maybe 35, 45 area as very deep contraction. So related to this member's question about whether or not we could see this area right here, the answer is basically yes. A deep pullback could correlate around this level for deep support. But we also have these secondary levels, which are essentially between here and here as primary support. And if you look at that, that puts us around the 3890, 3900 level, maybe down to the 3780, 3790 level. So my assumption would be that we are going to be targeting this. And again, you can see these levels, these 382 levels here line up. Try to highlight this. My assumption is that we are going to be targeting these levels as critical support as we attempt to move forward with trend. Okay, we are not going to be. Hey, Jamie, can you hear me? You're on mute, buddy. I can't hear you. You've got to unmute yourself. Let me see if I've got my speakers set up correctly. Hold on. Should. Yep, I do. So if your microphone is working, Jamie, you should be good. Lawrence, nice to see you. If you have any questions, please put them in the chat. We'll be happy to help. And like I said, I'm going over Fibonacci price theory right now related to the member question as to whether or not the 3,500 area down here is a viable target for a Q3 or Q4 pullback. So understand that. And Jamie, let me know when you're on. I'm going to move over here and see if I can find you. Make sure your speakers work. I know you did this last time, it worked. But again, the 3,500 area is a viable pullback. Why? Let me go through it again. It's because this provides ultimate critical support based on Fibonacci price theory. This is our ultimate low. This is our ultimate high, way up here at 48.15 roughly. So ultimately, price needs to move either below this level to continue to trend downward or above this level to break out to new highs. Now, we do have secondary, what's called unique highs and lows. I've drawn them here. This is a unique high. So this becomes our secondary resistance level, and this becomes our third active resistance level right here at 41.90 roughly. So closing above this 41.90 level today on the SPX 500 would be very, very positive for continued upward movement. Remember, I've highlighted here, this was our first breach to the upside, indicating bullish trending was taking place on this weekly chart. It would obviously be earlier on daily or hourly or 2 hour. But this provided confirmation that price was rejecting down here, moving higher, broke above this critical price high right here. It rolled around, established a unique low, or sorry, critical low here, and then eventually rallied back up, taking out this, almost taking out this level, was rejected, set up this critical price high, then closed above it. This was our second buy or bullish trigger. This was our third buy or bullish trigger, breaking above this critical price high. Or it's actually a double top, but based on this period, we had at least 15 bars, which makes it a unique price high. Now we're getting above this unique price high right here, and we need to see how this plays out. Second. Jamie, I don't know. Can you hear me? Message me in chat, Jamie, if you're having trouble, or on WhatsApp. Like to get you in here, and I don't know exactly how. It shows you as a presenter, but I can't hear you. And again, folks, technical difficulties are not uncommon for all of us. Okay, you can hear me, but maybe I need to, let me look here. Mute, share video. Maybe I need to, let me see here. Make you a presenter. It says waiting for response. Polls, participants. Hold on, Lawrence. Let me see if I can figure this out. Jamie, try to log out and log back in using that co-presenter link. Let me see what, now you're back in. Let me see what we have here. So I think I can switch to your screen. I don't know. This worked last time. I don't know. All right, Lawrence. Well, while we try to figure this out, let me do this. Okay, you did. You logged out and logged back in. Okay, we're going to have to figure this out. I don't know. It says you're muted again. Try to unmute and check your sound settings to make sure that you can actually communicate. My sound is all the way up. Yep, all the way up. So should be able to hear you. And what we are going to do here is we are going to, Lawrence, do you have any questions for Jamie? He can probably answer them in the chat. I am going to move over to the data regarding the fully automated trading systems. So what we're going to do is we're going to first look at the Symphony system. Symphony is a very unique, very structured date, time, price, activity or trading model. It is very unique. In fact, I love this strategy simply because it trades very infrequently. It trades very cleanly, and it has a great potential for long-term growth. I've done some modeling in the past. I'll have to see if I can find it. Whereas if you started with the Symphony E-micro system, which is this version right here, trades paper barrels, E-micro crude oil, euro dollar, US euro to US dollar, soybeans, Dow Jones E-mini futures, E-micro gold, and E-micro Bitcoin or micro Bitcoin. You essentially need about a $4,000 or $5,000 minimum, and that's absolute minimum starting account. You could start with a $8,000, $9,000, $10,000 account that just gives you extra balance to carry forward. The opportunity for you is that you would be averaging approximately, and this is an average over the last 15 years, this basically you would be averaging about $8,000 to $10,000 basically a year. So you'd figure out somewhere between 8,500, maybe 9,500. I like to pick on the low side per year. And if you were to increase your trading account from one contract to 2 to 3 to 4, leaving a fairly solid base in your account. And the way you would do this is, and I'm going to have to maybe see if I can do this here. The way you would do this, the way I would propose that you would do this, which is what I'm actually trying to do, is you would start with, say, 8,500, and you would trade one contract. So I'm going to set it up here as one contract. We're going to go ahead and set up roughly an $8,500 per year return, which is equal divide by 12. Sets us up at a $700 per month return. That's about where we're at with this. So we're going to go ahead and set this up as month one, and then set this as month two, and we're going to say this is here. And I know I've done this before, but I'm just going to get this set up real quick so you can see. So these are months. These are contracts. So if we were to have equals that plus roughly this. Now, this is just simplified, folks. This does not give you full scope of what's going on. And Jamie, like I said, feel free to add any comments in chat until we figure this out. We're going to have to just keep moving with this to try to get through this. And like I said, I'm going to try to move through this so that we can figure out how to get you working. You're still on mute again for some reason, but I don't know. We'll figure it out. So again, if you were to see this continue to move forward, so we'll move here plus this. I have to do this. So we're going to come in here, get this to work properly. It's going to be that means this. Perfect. Now, if I carry this down, I love Excel. I've learned enough secrets in Excel to be somewhat dangerous. So if you were to continue to move forward and we wanted to try to allocate a cash reserve of, say, 33%. So let's go ahead and put 33 in here and allocate as a percentage. So your cash reserve on 33% would be that times that. You would be allocating how much could you physically trade would be that as that. And when you're at this point, you would be essentially, so this would be the same, equals this, equals this, equals that. Clear equals that times that, sorry, equals that. Equals that actually times three. Nope, equals minus that time that. And there we go. Okay, so this is your trading capital. How much you're allocating to actual trading. And so what we do is on a base model, it trades very infrequently. What we're going to be able to do is we're going to be able to determine every time we're able to double up contracts. We're going to basically be doing that at our minimum level. Remember, our minimum level is 5,000. So that's the minimum level for Symphony, the E-micro version, to be able to double up contracts across the entire board. So now, make sure I've done this right. 3. Okay, that should do it. Now we come down here, and I'm going out what here about in a little over 10 years. It looks like about 13 years. So we start off at 8,500. It gives us enough to trade, plus about $2,800, $3,000 left over. As soon as we get here to 10,000, now we're capable of moving to 2 contracts. And now we start to double up our returns. Now, as soon as we get to 20,000, we're able to go to 3 contracts. And remember, we're still leaving 33% as reserve capital. Okay, now as soon as we get to 30,000, which we will go right here, we can go to 4 contracts. So, sorry, I'm doing this wrong. It's basically every $5,000 we're capable of doing this. So we went from 5,000 to 10,000 to 15,000, which would be 3, and then to 20,000, which would be 4, and then to 25,000, which would be 5, and then to 30,000, which would be 6, and then to 35,000, which would be 7, Remember, these are months, okay? So then to 40,000, which would be 8, and then to 45,000, which would be 9. Barely got above it right there. And then to 50,000, here's 10. You get the idea. And then it starts really ratcheting up. Okay, so at this point, what you're seeing is you're seeing real growth. So let's take a look at your actual growth here. So you're seeing month over month growth at the very beginning should be equal to our average expected month over month growth based on our $8,500 annual base per contract. This is one contract trading should produce about 8,500, 8 grand, 8,500 per year, broken down. Assumably, the average holds up about 7,000. Now we can knock this down. Okay, we can knock this down to say 6,900. Okay, but again, if you do this and you follow along, this is month over month. And what we're doing is I'm showing you how you can turn a $5,000 to $8,000 account into, and again, how many months does it take? So we come back over here. Here's our months. Here's 72. This would be 6 years. You would have turned an $8,000 account into $289,000 completely hands-free, almost 300,000, assuming it works and continues to work, which it has worked. The historical track record for Symphony, when we come back over and take a look at it, these back tests are run from 2000 to 2020. So this includes all types of activity, including 2 market corrections, and including the COVID crisis and the rotation in 2018 through the 2000 to 2004 bottom and through the 2007-8 top to the 2009-10 bottom. These are the averages of the returns going forward over that 20 roughly year time frame. Understand that the system trades 2000 or 20 to 35 times. And again, Jamie, if you can hear me, just chime in. I don't know how to make this work yet, so I'm just going forward with it. And this is the basic system. So this is they called the E-micro system. And what we'll do is Jamie and I will run a private webinar and try to figure this out and figure out how to get him in. Now, the Symphony Portfolio C is, again, the E-minis. So we're trading E-micros here for a very small basis amount. Again, sorry to highlight everything. Only requires $4,500 to $5,000 absolute minimum. You should probably start with at least $7,500, $8,000 in my estimation, related to having proper capital to handle drawdowns. Same thing here. This is trading the E-minis. Now, in reality, you could probably start with $20,000, $25,000, $30,000 minimum contract with trading with StoneX or others that have lower margin requirements. But look at the return price, 86,000 per year. That's an average annual return, average monthly return of about 7,000. The difference here, ladies and gentlemen, is that the E-micros and the E-minis trade at essentially 10 times the value. So the E-micro, for example, NASDAQ trades at $2 a point and costs, depending on who you're trading with, cost about 60, 70 cents to make a trade. If you're trading the E-mini NASDAQ NQ, it trades at $20 a point and costs about $2 roughly or less per trade. So your cost per trade is smaller and your point value, dollar per point value, is much larger. It's 10 times the E-micros. So again, running the same type of structure, we come down here, and if we were to turn around and say we need a minimum, let's see where we're at here, minimum investment of 35 grand, let's call it 40 grand, and our average monthly return based on this data right here, average number, I'll knock it down, 86, so I'll make it 72. I want to knock it down to be reasonable. 72,000. And of course, I got to spread everything out. Now you have the same scenario here. Okay, the absolute same scenario, which is we will start here with one contract, get back down. I'm only going to go to 10 because this is good enough. And I want you to understand that we need a minimum of 40 grand to leverage up contracts. So every time we get up above 40 grand with our trading capital, our allocated trading capital, this is how much we're actually allocating out of our 40 grand. Remember, we're holding $13,000 in reserves. So out of all of these numbers, out of all these trading capitals, when you look at this versus this, in fact, I'll put it over here. These are reserves. Very important. This is the amount of cash that you have in your account that you are essentially sitting on and not trading as a reserve. So you have 21 grand here, all the way down. And you can see as it grows. So now what we're going to do is we're going to come back over here, and essentially every time we get up above the next 40 level, okay, we're going to go ahead and decide where we're at with our trading. So our trading account here got to 80. That's double our number. We can go to 2 contracts. Now we're going to go up another 40 from 80, which would be 120. We can go up to 3 contracts. Understand that we are still storing massive amounts of reserves. Now from 120, another 40 grand up to 160, we can go to 4 contracts. Oops, I did this wrong. So equals this. Sorry guys, let me just do this. Because this is the real power of Symphony. And Lawrence, I know you're here, you're paying attention, so feel free to ask questions whenever you want. So I'm going to make this 2, follow along, help me out here. We're looking for the next increase. So from 80 grand up to 120 here is 3. And from 120 up to 160, we're going here to 4. And then we're going from where was I? 120 to 160. And then we're going up from 160 to 2, which is 5. And then to 240, which is 6. And then here we can go 7, basically, because we're going up. This one, nope. 6, that's right. Because that's 40, so we'll go 7 here. And that's almost 40 grand. I will go 8 here. I will go 9 here. And I will go 10 here. So you see how quickly it took us 2 years to go from 1 contract up to 10 contracts. And what we have here is a growth, a reserve being built as we're trading up to this point. So let's highlight this area because this is where we got to the 24 months. And I want you to understand that this was 2 years of trading, 2 years of essentially running the Symphony strategy, starting with a $40,000 account. You end up with a $600,000 account. After 2 years, you have grown your account by more than, if I do the math real quick, this divided by this. And this would be a percentage. By 1,500% trading futures. And all you're doing, the way I propose you do this, is you allocate more money into your reserve. This is your reserve allocation. And the purpose of this is to make sure that you can withstand the bumps and the grinds of daily trading without sweating anything. Remember, this is fully automated, so you don't really even have to touch it. We have it set up where we can open an account with Striker or with a couple other hands-free types of solutions. You get yourself set up. It trades completely automated. You don't have to look at it. You don't have to touch it. It's basically runs 24/7 for you. So this is the E-mini, this version here, the E-mini Symphony Portfolio C. And then, of course, like I said, if you're even interested in bigger versions, we have the Portfolio B, which is again properly balanced. That's why we trade these 6 different symbols. This gives us balance and diversification across many different futures markets. We're not likely to see any massive crash in any major event cycle, COVID, or anything else. The returns are balanced and efficient for long-term traders. So ideally, you could be running Symphony B as a portion of your portfolio. Again, requires about the same amount of money, produces a little bit more. You can see here the comparison of 86,000 annual with this version versus 102 annual with this version. Still trades the same. You will be basically trading 2 to 7 trades a month. That's it. 2 to 7 trades a month. The trades typically last 2 to maybe 5, 6, 7 days, maybe. It's all self-contained, and it is a quantifiable model that is looking for date, time, price events, letting you know when or taking an opportunity of trades when they set up. There you go, Jamie. Yep, disclosure. I see you're posting. So again, Lawrence, do you have any questions at this point? I know that I'm trying to carry on. I wish Jamie could talk, but Jamie, I'm doing my best here for you. And again, I want to highlight that you could be taking advantage of Symphony Portfolio B or the A portfolio. This is what I call the big boy portfolio. This trades the gasoline, Euro futures, soybeans. Whoops. There I go. Soybean, E-mini, NASDAQ futures, the NQ. These are the E-minis. Silver and micro Bitcoin produces about $300,000 return on investment, requires an absolute bare minimum, 45,000 to get started. So, I mean, we could have a little fun coming over here, and if I really wanted to, so this would be Symphony C. I believe this was Symphony C, and we'll make this bigger. And if we really wanted to, we could have a little fun by copying this, putting in the numbers. I'll leave it similar to where we're at here. Come back over here. And I'm just kind of on the fly winging this because what the heck? And A, and now let's come into A and set this up. This should be our trading model. Let's set this everything. And so A would be a minimum, let's call it, of 65,000. Annual returns of was about 300, so I'll make it 275. Symphony C was, if I remember right, 102, so I'll make that 85. What I'm doing with the annual returns is I'm knocking it down by 25%. I want you to be prepared for lower than average returns. Requires 45 grand, so we'll make this 55 grand. And again, leaving the contracts where we're at, which should work. So hypothetically, it requires 65 grand. We have our allocation, our reserve here of roughly 21,000, trading only 43 grand at any given time. And again, we've modified this so we have the ability to increment this a bit higher. That gives us, what I've done is I've incremented the starting capital enough to cover the reserve, which will give us the ability to trade and have reserve capital in case there's some drawdown at the very beginning. And we maintain that reserve capital going forward. So now you can see how the equity curves look. And again, if we were to take a look at the account and we were to, let's see if I can do this. I think I can do this like this. It'll just have and go insert chart, base chart. There is, now remember what happens here is this is Symphony A. Oops. So what happens here is we're not growing the capital, okay? And again, see if I can get this. But what I hate about, well, actually, I think there's a way to do this. If I Control C and delete, and then come back up here and Control V, yeah, it allows me to paste it. So understand that here we are not growing capital. The time series here is the flat line here. But remember, we're not growing capital after 10. Once we get to 10 here, we're not growing capital. So we could essentially say, okay, you know, once we start picking numbers, let's just say we get to 1 million, we go to 15 contracts. And then once we get to 2 million, we go to 20 contracts. And once we get to 3 million here, $3 million will go to 25 contracts. And 4 million will go to 30. So what happens here, guys, is like I said, we're maintaining a huge reserve. Okay. And what we're doing in this is we're incrementing our growth strategy so that we're capable of taking advantage of this very slow strategy by maintaining massive amounts of reserves. You got $600,000 in the account. You're only trading $400,000. You've got $200,000+ sitting in a reserve capital that you can actually, because this is reserve and because you're gaining this on a monthly basis, you're gaining $54,000 a month right now. You could start allocating a draw off of this. And remember, it only takes 2 years. You start with an amount of money, you build it up for 2 years. And at this point, because you're making 50, 60, roughly thousand, again, these are all estimates. I'm just trying to give you a guide. This is how I plan on executing. I started with Jamie just a few months ago with my account. But the long and short of it is the goal here is once you get to this point, you can start pulling 10, 20% off and live off of this number. You can physically live off of this number. And again, if we come back over to the Symphony, the basic portfolio, it's 4,500. I'll make it, let's call it 8,500 is what you have to start with. And again, we had returns of about let's call it 8,200. I think that puts us in, that's actually lower than what I started with. So what you're doing is you are starting to see returns by the 24th month here, which is right here. You're starting to see returns of $6,000 a month. I mean, you literally, and you have a reserve of $28,000. So as you're building these reserves, you could theoretically start taking, you know, a third or a half of these returns as part of your reserves and start drawing off of those. You could start drawing $3,000, $4,000, $5,000 a month while the system continues to build, as long as we're not seeing massive drawdowns. So hypothetically, if we were to say 20% of reserves at this point times 0.2, you could start, well, let's do this. Let's make it equals reserve times 0.1 plus monthly return times 0.1, 10% of reserves and 10% of monthly return. You could start pulling $3,400 a month. And I'm going to do this for both of them or all of them so you can see. So we're going to do it here and here. We'll expand these out. And you can see by the third year, you can pull a $60,000 a year income off of this. By the, let's go to the end of the third year, which is right here. We'll highlight this, end of the 4th year, which is right here. Highlight this, and you can see that by the time you get into the 5th year, this would be the January, February, March. So we would have to go to 60. That would be your monthly net draw off of the account after 5 years. Now, what would it cost you to do this? Okay, it's very inexpensive. In reality, running it completely hands-free, when you look at the actual Symphony portfolio and you want to learn how to do this, look, the Symphony e-micro portfolio annual deal subscription is $2,250 per year. So again, take a look at the numbers. It's making a roughly $8,000 to $11,000 a year. So let's go ahead and factor in the costs. So this is costing you $2,250 a year. Right now, we come back over to the Excel spreadsheet. Let's factor in the costs. So what we are going to do is take, let's call it 2,500. Let's make it a nice even number. This is physical cost. We'll make this a nice even number, a nice odd fill color so we know it's an actual physical cost. And what we are going to do here is we are going to deduct the physical cost of the actual profits that we make. So we are going to take this number every month. We're going to allocate minus this number, divide by 12. Obviously, this formula does not look right. Okay, there we go. So there you go with the odds of breaking it down. So what did I do here? 8,200 divided by 12, 2,500 minus H3, H1 divided by 12 minus H3 divided by 12. That doesn't make any sense because H1 is higher. Let's do this. Yeah, okay, I got them backwards. Watch this. Take this, divide by 12, and we will say this minus this. So now we've allocated for monthly cost. Now what happens again, you're still seeing the returns. They're just covering the cost of renting or leasing the system. You don't own it. It's not going to be yours forever. This is you pay Jamie essentially to run the system. But again, you can see the actual physical cost here. And again, by the end of the 3rd or 4th year, look at what you're taking home. You're taking home essentially this potentially this amount of money every month, and it grows about 200, 300, 400 bucks a month every month going forward. And what this is doing is this is allowing you to compound. So understand that if we were really to reduce the allocation to say 25% and allocate, become more aggressive, we could start becoming more aggressive when we start incrementally moving ourselves higher. So we could incrementally move higher. So our base allocation is 8,500. Half of 8,500 would be 4,200. If we really wanted to, maintaining the allocation, we could start moving incrementally higher. And again, just as an example, Control C, Control V, there we go. Incrementally higher. When we start looking at moving incrementally higher, we go to 2, we go to 3, we go to 4, we go to 5. All I'm doing is basically every 3 months, because we're growing by more than 1/2 of our number, we go to 6, we go to 7, we go to 8, we go to 9, and we'll go to 10 here. Again, covering all the costs. Your $8,500 account turns into a $96,000 account by the end of year 3, allowing you to start drawing basically $3,000 to $4,000 a month in income as long as you continue to run the system, covering all costs. Okay, so the Symphony systems are the first primary system you need to look at. I suggest you look at the eMicro system first, or that would be Symphony.D or Symphony.C. The numbers play out for themselves very clearly, and they give you a lot of opportunity to grow. So remember, if you're struggling, if you're trying to trade, you have, say, $100,000 in your account and you're trying to trade and you're putting a lot of time and energy into managing your trades and trying to find the right opportunities, this is a way for you to come in and to really put something to work that is completely hands-free. It takes about 36 months for you to get to a point where you can start, drawing an income off of it. And it only requires about $8,000 to get started. Or in this case, like I said, Symphony.B, which is the first level up, really about $45,000 to get started. And this will give you the ability, as I mentioned to you earlier, if you reserve 25% of your capital and become fairly aggressive, by the end of year 3, you're looking at pulling $6,000 a month potentially out of the Symphony strategy to be able to really grow your wealth. To get the same one, and to provide you the ability to continue trading on an ongoing basis, however you want, with the remainder of your capital. That's the real goal here, is to teach you how to become very efficient with your trading style and your trading structure to be able to grow your wealth efficiently, completely hands-free. And I think I've done a pretty good job of explaining to you how I would set it up, how I would run it, how I would allocate contracts going forward based on a reserve capital structure, making sure that I always have a reserve capital in place, especially through the first 2 years. Once you get past the second and third year, then you're capable of really starting to draw an income. And like I said, once you get down here, remember, we're not incrementing this, but you're talking, 5, 6 years later, you're still drawing $75,000 a year in income off of the system while it's continuing to grow. Or in Symphony.B, which is this one back here in the 5, 6 year time frame, you're drawing $120,000 a year income, roughly 100, 120 grand off of the system while it is continuing to grow your account. And that's the real growth of this full automation. That's the real benefit. Being able to rely on something that is hands-free, that'll do what you want without any real issues going forward. No real massive drawdowns. Of course, you're going to see losing trades. That happens. You're going to see a couple of losing trades. I guarantee it. That's going to happen. But consistency and not over trading and being completely hands-free is really, really what's important. Okay, Jamie, I'm sorry that we couldn't get you in here. So the smaller portfolio is also managed. I have a small portfolio. Yes, Lawrence, I'm sorry. Yes, 100% Auto X. Remember, Jamie, thanks for handling all of these. Lawrence, if you have any questions, email me. Go to my website, Ment.com. Remember, here's my website. It's all right here on my website. These are only one strategy, folks. We're going to get deeper and deeper into it. Jamie's going to be joining me at least twice a month, and we're going to figure out how to get this put together for everyone so Jamie can participate. Jamie, again, thanks for helping out. Same time. In fact, we're going to do a private one, Jamie. You and I will try one maybe this weekend if we have time and try to figure it out. Okay, guys, that's it for now. I will be posting new webinars this weekend. New next 2-3 weeks of webinars will be set up. We will try to do these around the end of market trading for these live automated trading webinars. That way you can actually see them work once we get Jamie connected and working, and actually we can hear him. Thanks, Jamie. Talk later. Bye.